So we finished direct materials and direct labor. Now we're going to do factory overhead variances. This one looks different because we are going to break down factory overhead into the fixed and variable components. So this is our factory overhead cost budget, and we're going to list our direct labor hours because we allocate our fixed overhead based on direct labor hours. So that's why our direct labor hours are up here. So when we want to figure out our rate, we need to know these direct labor hours. So we're going to break down costs. So we've determined these are your variable costs and these are your fixed costs. When we add them together, we get our factory overhead costs. Then we want to figure out what our rate is. So we can say our rate is $30,000 because we're doing this at 100%. Divided by our direct labor hours, 5,000, and that tells us our rate. So if you remember your overhead rate from the previous chapter, it was estimated overhead divided by your estimated base, and that's why we're dividing by this estimated base right here. So here's the formula that I was talking about. Earlier we had estimated overhead divided by estimated base. Now we've got budgeted factory overhead at normal capacity, which is 100%, divided by normal productive capacity, which is the $30,000 and 5,000 direct labor hours. And that's how we get our $6 per direct labor hour. So this is our budgeted rate, just like we did in our previous chapter, but now we're doing it, this chapter we're doing it for the budget. So in order to analyze this and make it more meaningful for managers, we're going to subdivide this into variable and fixed overhead rates. So for us, the first one, which is variable, we do budgeted variable overhead at normal capacity divided by normal productive capacity. And we find out that it is $360 per direct labor head hour. For the fixed one, we do the same thing, 12,000 divided by 5,000, and it's $240. So we've just broken it down into variable and fixed overhead. So there are two rates, and we see when we combine them, we get the total of 6. So the variable factory overhead is considered controllable variance, and it is the difference between the actual variable overhead cost and the budgeted variable overhead for actual production. Again, it's the difference between the actual and the standard. So earlier we were calling it standard, what we expected, and now when we're talking about overhead, we call it budgeted. It's the same thing. That's what we thought compared, this is what we thought compared to what was actual. If the actual variable overhead rate is less than the budgeted, the variance is favorable. If the actual overhead exceeds the budgeted, then the variance would be unfavorable. The budgeted variable factory overhead is the standard variable overhead for the actual units produced. So we want to compute it as standard hours for actual units produced times the variable factory overhead rate, which is what we just calculated. So for budgeted overhead for Western Ryder, 5,000 units were produced, so that's our actual. So we compute it like this. Standard hours for actual units produced is 4,000 direct labor head hours times our 360 variable factory overhead rate gives you 14,400. Assume that they had the actual factory overhead cost of 22,400. So we would say that variable factory overhead controllable variance is a 4,000 favorable, and we would compute that. Remember, we're doing variable as 10,400. Let me go back here. 10,400 actual, because this is actual variable right here. And then we calculated our budgeted variable as 14,400. So we find out that we have a favorable 4,000 favorable variance. Okay, so let's look at this example right here. So our formula is right here, actual variable factory overhead minus budgeted variable factory overhead. So our actual's given. It's 16,850. So we're going to put that right there. Now we're going to calculate a budgeted variable. We're going to do that by saying our 3,000 units times our standard hours per units. We'll do that. Okay. And then we'll times that by our 220. This is our overhead cost per unit. Per 220 per hour. So when we subtract, we get 350 of unfavorable. Okay, so that was variable, and now we're going to look at fixed. So the fixed factory overhead volume variance is the difference between the budgeted fixed overhead at 100% of normal capacity and the standard fixed overhead for the actual units produced. Okay, so for Western Ryder, it would be computed as follows. The standard hours for 100% of normal capacity is 5,000. The standard hours for actual units produced is 4,000. So that's a $1,000 difference. And then we're going to times it by the fixed overhead rate. When we multiply, we find that we have a 2,400 unfavorable variance for fixed overhead. And the unfavorable volume variance could be due to all sorts of issues. And it could be due to failure to maintain an even flow of work stoppages caused by lack of materials or lack of skilled labor, machine breakdowns, lack of enough sales orders to keep the factory operating at normal capacity. So let's work this example for factory volume overhead variance. So Tip Top Corporation produced 3,000 units of product that required 2.5 standard hours per unit. The standard fixed overhead cost per unit is 90 cents per hour at 8,000 hours, which is 100% of normal capacity. Determine the fixed factory overhead volume variance. So we have 8,000 standard hours, that's our standard hours, when we're operating at 100% normal capacity. Then to get the second, you need the standard hours for actual units produced. So we produce 3,000 and it requires 2.5 hours per unit. So you would do 3,000 times 2.5. So that would be 7,500. So standard hours is 88,000, and it took us 7,500. All right. So 8,000 is what we did, but we actually should have spent 7,500 hours. So we used more hours. And when we times that by 90 cents per hour for our factory overhead rate fixed, we get 450. So this would be unfavorable. So just like we did for direct material and direct labor, when we add the two variances together, we will get our total fixed overhead cost variance. So we'll do our variable factory overhead controllable variance and our fixed factory overhead volume variance, and we will get our total factory overhead cost variance. This one was favorable because our favorable was more than our unfavorable. So take a minute and study this. This is the same as factory overhead we had earlier, where we break it down into our variable and our fixed and our total. And we've added our columns to show our variance. So the amount that we've computed is computed like this. Standard hours for actual units produced times our total factory overhead rate. And our actual is given from actual costs that we have incurred. And so at the end of this period, we still do the same thing we've always done. We need to close our factory overhead account. So if we were underapplied, let's see. If we were underapplied, that would mean the actual factory overhead costs are more than the applied factory overhead. And if we have if we had the opposite, it would be over applied. So the difference between the actual factory overhead and the applied factory overhead is a total factory overhead cost variance. So the underapplied and overapplied factory overhead account balances represent the following total overhead cost variances. So if you have an underapplied factory overhead, you have an unfavorable total factory overhead cost variance. If you have overapplied factory overhead, you have a favorable total factory overhead cost variance. Here it is in a T account. So actual is always debited to factory overhead.